Welcome to another episode by reitspro.com, a place for insightful articles, videos and blogs on REITs in India. This episode answers two fundamental questions on real estate investing. Number one, how can I get exposure in real estate markets? And number two, what is the kind of money that I would need to get this exposure? There are three fundamental ways which we can use to put our money into real estate. The first one is direct property investing. The second one is investing in real estate operating companies, and third is by way of collective investments, which could also take the form of alternate investment funds or real estate investment trusts. So let's take up the first one right now, which is direct real estate investing. In this investing, we need to firstly understand what is our requirement. Do we require a residential asset, or do we require a commercial asset or an institutional asset, or so on? And the amount of money that we need to put in would depend on whether we would wish to take a loan on investing this or not. So in case of real estate investing, for example, there is something called the LTV, or the loan to value ratio. In most housing loans, we can get up to 80% of loan, and 20% is the kind of equity that one has to put in. This 80% needs to be repaid over a period of time by way of installments or lump sum payments, whatever is decided between you and the lender. If your direct property purchase is not residential but commercial, retail, institutional and so on, there could be various other ways loans are worked out in such cases. Even in case of plots, there is a loan which can be taken, loan on properties can be done, or in case of constructed commercial property, lease rent discounting can be worked out, and so on. Of course, the interest rates would be higher than term loans given on home loans, and also there are variations in terms of what is the interest that is charged to you. So the interest could also be higher than home loans, because the lenders typically understand that the risks involved are higher with commercial and institutional and retail properties than what it is on home loans. Do remember that when you take a loan on any property, be it the housing loan or commercial property or whatever other property, the income levels or the repayment capacity of the borrower is also assessed. Additionally, if you take commercial property directly, there could be other avenues like crowdfunding or property fractional share investing, where we have made another video for that, and you can look at that. That's another way of directly investing in property with a lower ticket size. In case you wish to invest your money through real estate operating companies, one needs to also understand that this is like investing in a manufacturing sector, because real estate operating companies could have any kind of asset. It could be commercial or residential and so on, and that asset is usually treated as stock in trade. The company takes a particular piece of land, builds on it, and then sells the finished product. So you generally have land as stock in trade, not for a pure investment reason. So as an investor, you are also exposed to the vagaries of a business. You're not just exposed to how the property movements happen, but also the kind of loans the real estate operating company would take, or what is the intention of the promoter, how does it distribute profits and so on. The kind of money that is involved in case of your decision to invest in real estate operating companies is very much guided by how the stock markets list the shares of the various manufacturing or builder or developer companies. This is a snapshot of the various developers who are listed on the stock exchange. It's a part of the realty index. These companies are a part of the realty index. So depending on what your investment requirement is, you can put in that much amount of money. And of course, the stock market has its own rules on how you can put in margins, and you can take loans on these as well. The third category is investment through pooled vehicles. So one of the most common ones which is now emerging is by way of real estate investment trusts. Now these are companies which own and operate income generating commercial assets. So you need to be clear that when you go in for REITs, you will necessarily invest in commercial real estate, and you will derive the benefits or the risk of commercial real estate. So the difference between the real estate operating companies and REITs happens to be only this: real estate operating companies do a certain work of development, and in case of REITs, that's a very small portion. Most of the work that they do is about owning and managing rent generating completed commercial assets. So whatever comes in as rentals is in fact distributed to the unit holders. So how much money can you really invest in that? That totally depends on what are the listing requirements that have been stipulated today. So today you can buy as little as 1 unit of a REIT. So this is a snapshot of the listed REITs in India, and you can go ahead and buy as less as 1 unit of a REIT and be an owner of all the underlying assets that that particular REIT owns. To summarize, you can invest in real estate in 3 main ways. First, you can invest directly, where you'll need bulk money and you can supplement that with loans. Number 2, you can invest through the stock exchange, where you can invest in developer stocks, which are however not very close to purchasing real estate because you are affected by the business itself of development. Number 3, you can invest in commercial real estate, which is rent generating, through real estate investment trusts or REITs. To know a lot more about real estate investing and REITs, have a look at these 2 books, the description of which is given below. Subscribe to our videos to know more about REITs and invits and real estate investing in future.